there's two ways to look at it. So one is from the defensive side, which is all the risks that climate change poses to companies, to societies. So you've seen a lot of investment in mitigation in Europe in particular, but also in Asia, especially in China. So recognizing that in 30 years' time, in even 10 years' time, some of the buildings that we have, some of the infrastructure that we have might not stand up to the temperature stresses we're going to see up and down over time. So that's from a risk management perspective, so governments and societies playing that role. From an opportunities perspective, I think you've seen a lot more front-footedness, particularly in Asia. So if you look at the manufacturing of anything to do with renewable energy, that is really booming. Anything to do with cleaner types of operations, whether that is to do with transport or to do with the way that you actually manufacture products as well. There's an understanding there that this is the future and you may as well get ahead of the curve rather than protecting legacy industries too much.
Hello and greetings. Welcome to our International Business Today podcast series. I'm Professor Ravi Sarathy, Professor of International Business and Strategy at the mckim School of Business at Northeastern University. My guest today is Kevin Chuah. He's an assistant professor of international business and strategy at Northeastern University's mckim School of Business. He's also a research fellow at the Wharton School in its ESG Initiative. And his research interests are quite wide. They relate to corporate governance, to sustainability strategy and practice, and responsible investments. Before he became an academic, Kevin worked as a portfolio manager at BlackRock within their multi-asset strategies group. And he's also done similar investment roles at other investment companies. Kevin has a PhD from the London Business School in strategy and entrepreneurship. He also has a master's degree in statistics, an MSc from the London School of Economics, and undergraduate degree, a Bachelor of Commerce from the University of New South Wales in Sydney. Kevin, it's a delight to have you back on the International Business Today podcast series to continue our conversations and to hear from you about your deep knowledge and research in the area of sustainability.
Thanks, Ravi. Great to be back.
So, Kevin, let's start by reviewing how sustainability strategy and strategies to cope with climate change have evolved in the past few years.
Yeah, I'll take you back to 2016, actually, because that's when you had the United Nations and the Sustainable Development Goals. You also had the Paris Climate Agreement being ratified around that point in time. And in the years following that, there was a lot of momentum across a lot of countries, a lot of companies really recognizing the importance of sustainability for their own business strategies, but then also for the communities and the broader societies they operate in. I'd say that the big shift in the last few years has really become as political sentiment has changed. So part of that has been to do with states here in the US in particular putting in place legislation that is trying to protect some of the industries that are going to be potentially losers when it comes to the climate transition. So when you look at, say, Oklahoma and Texas, some of those states have made it more difficult to make investments that are pro-sustainability because they're concerned that that's going to damage those industries. You also see shifts in regulation during that time as well. So in a few years ago, 2021, 2022, you had the Securities and Exchange Commission, the securities regulator here in the US, looking at what should the disclosure rules be on sustainability and climate in particular. And we've just seen in the end of 24 and into 2025 now, a lot of that disclosure rule being wound back as there's less interest in focusing on those sorts of issues.
So if I parse you right, there is pushback from certain states that wish to protect their legacy energy industries. And there's also a pushback, not pushback, I should say, a retreat among regulators when it comes to either promulgating sustainability-oriented regulations or in disclosure requirements. But what about the broad public and firms in general? Has enthusiasm and support for the green movement, for sustainability-focused strategies declined across that broad spectrum?
There's a lot of variation there. So I'd say starting out with the US, I'd say that there is a divide in large way on political lines in the population in terms of the importance of the environment and sustainability issues. In the business world, I'd actually say it's also divided, but there's a general recognition that there are efficiencies to be gained by becoming more sustainable. There are risks that sustainability and climate change effects on the business side. So businesses are still being aware of these issues and trying to take them into account. There is a difference, though, between how much I think they're willing to talk about what they do now, because they don't want to be too much in the limelight about this. But when it comes to good risk management, good efficiency savings, then companies are still focused on these sorts of issues. So I'd say that's in the US. In other countries, especially in Europe, in Asia, where regulation is different, where the general population is viewing climate change as a much greater threat, I'd say, then you're seeing much more proactive movement there. But having said that, even there's some retreat to some extent.
My impression from listening to you and from my reading is that there are many different actors, many different interest groups who together affect the success of any sustainability-focused strategy. So is sustainability, positive achievement and progress necessarily a collective action problem?
I think it is. It's probably of our time the definition of the grandest collective action problem we have. And the reason for that is that if I pollute where I am, if I generate carbon emissions in my business, say here in Boston, then that is going to affect globally what the concentrations of carbon dioxide are for people in many other countries. So it means that we need to be cognizant of the effects that our behaviors have in our locations on a global basis. And then there's all these feedback loops because climate is a very tricky beast to understand, to try to tackle. And there's lots of unpredictable things that can happen. So you might have temperature rises in one place, you might have extreme temperature declines in others, but on average, that volatility and that extremity is actually the result of all of our different behaviors at the same time.
So if you think about the firm is supported by investors, by banks, by capital markets in general, to some extent by national governments who are interested in promoting certain industries, industrial policies, by NGOs who may or may not be sometimes at odds with the firm, and then, of course, consumers who make decisions to some extent about what they will consume and from whom, guided by their own sustainability interests. So are there variations among these different groups that I just mentioned? And if so, what are the implications of those variations?
Yeah, there's huge variations there. I think I'm just focusing on, say, the firms because we're focused on international business. A lot of that depends geographically, and that comes down to, yes, the regulations in the places they operate. It also comes down to, yes, the preferences of the consumers and the other types of pressures that they're getting from society, including from NGOs and the like. There's also the physical risk element of it because different parts of the world are exposed to different types of climate risks, different types of sustainability challenges. So in some places of the world, it's water risk, water stress, which is the biggest problem. If that's part of your supply chain, then that's clearly an issue. In other cases, it can be to do with fire, it can be to do with growing seasons and things like that, and if that's changing. So there's immense variation there. I think in terms of the dimensions that we can think about, at the moment, what is front and center is definitely physical risk and also definitely regulatory risk. I'd say they're the two biggest drivers of what's front and center of mind for companies' executives at the moment.
So given the recent floods in the Midwest and the fires in LA, the earthquakes recently, insurance companies are probably at the front lines of the consequences of these sustainability or lack thereof. Mm-hmm. So how does that happen? How does an insurance company today manage its business viably, knowing that sustainability strategies probably can affect it positively, when perhaps, as you point out, interest is declining across the board?
I'd say it's with great difficulty that, and I think insurance companies are facing lots of challenges. You are seeing them actually move out of markets where the risks are just too unknown or too difficult to price. I think for a lot of insurance companies, when sustainability risks increase, that can actually be an opportunity for them because people want to take out flood insurance, they want to take out hurricane insurance, and so they can actually raise the premiums for that. But at some point, it becomes uneconomical for insurers to actually operate in those markets. If you think of real estate in some low-lying states, especially places like Florida, Louisiana, which continually get hit by hurricanes. If you look at California, where you're having wildfires in what is meant to be a winter, then from an insurance modeling perspective, how can you actually understand what your liabilities could be? Now, the challenge there for business, I'd say, is twofold. So on one case, it's, well, if we can't get insurance, then can we actually operate in those locations? The second is that if the people that work in our businesses can't get home insurance, can't get other types of insurance, then can they really live there and work in our businesses in those locations? So it's very tricky for insurance companies, but then there's huge implications for companies and then people as well.
Now, earlier you alluded to differences across geographic regions, and you suggested that perhaps there's greater enthusiasm for these sustainability-oriented strategies in Europe and in Asia. So, for example, how do the European Union and China vary and go in a different direction perhaps from the US? And again, we're talking about a fairly short period of time, the last 4 years.
Yeah, exactly. I think there's two ways to look at it. So one is from the defensive side, which is all the risks that climate change poses to companies, to societies. So you've seen a lot of investment in mitigation in Europe in particular, but also in Asia, especially in China. So recognizing that in 30 years' time, in even 10 years' time, some of the buildings that we have, some of the infrastructure that we have might not stand up to the temperature stresses we're going to see up and down over time, water levels or sea rise levels, all that sort of thing, water distress, especially when it comes to the large river systems. And then what can that actually do for food systems? That's a complete other story. So that's from a risk management perspective, so governments and societies playing that role. From an opportunities perspective, I think you've seen a lot more front-footedness, particularly in Asia. So if you look at the manufacturing of anything to do with renewable energy, that is really booming. Anything to do with cleaner types of operations, whether that is to do with transport or to do with the way that you actually manufacture products as well. there's an understanding there that this is the future and you may as well get ahead of the curve rather than protecting legacy industries too much.
Now, you also talked about regulation and regulatory retreat, right? So can you give me some examples of variation in regulations and how they might motivate different behaviors, pro or less focused on sustainability?
Yeah, so I'll use Europe as the example there, I think, because that's where it's probably been most advanced so far from a regulatory perspective, and also having potentially the widest reach. So in the European Union, you've had the two big pieces of regulation coming in around corporate sustainability, which is really requiring companies to disclose more the impacts of sustainability, but then also to do more deep due diligence in terms of how different parts of their supply chain will get affected. What's interesting about that regulation is that it is extrajudicial. So what it means is that companies that operate in Europe, whether they also operate in other parts of the world, they'll need to do this sort of disclosure and this sort of due diligence to understand the risks that they're facing. However, we are seeing some pushback on that, and actually even in the EU, as far advanced as they have been, there has been some rolling back of those initiatives. So, for example, we've had those two requirements, those two directives coming in. They're called CSRD, CSDDD. They've been delayed in terms of their implementation by a couple of years. So, even there, where it's progressive, you're seeing some pullback. Here in the States, you had some promising work by the Securities and Exchange Commission, which is the securities regulator here, really requiring larger companies to disclose key climate-related metrics, recognizing that this is a financially material risk for many, many different industries. When the final ruling of that actually came out last year, you saw that was watered down quite a bit. Then it got actually challenged by a lot of companies, and now you've actually seen that regulation actually go away. At the same time, though, you still have regulation in California that's due to come in place in the next couple of years, and that's probably as wide-reaching, as front-footed, I'd say, as the EU, if not more. And what we'll have to see is the interplay there between California rules and then potentially what the federal government tries to do if it tries to rein that in.
Interesting. This seems to underline, at least in the US, the degree of both political and perhaps market polarization. Would you agree that there are such fairly significant divides? And to what extent, maybe, is it political ideology rather than purely sustainability focused? What does the data say? Is there room for disagreement over the urgency and over the need for some continued interest in sustainability?
So the example that I'll use there actually is if you look at the different state pension funds here in the US. So if you look at the California state funds, so you have there the California State Teachers Fund and a teacher retirement system, and the public employee retirement system, CalPERS. So both of those have really embraced sustainability, and California as a state has generally embraced sustainability and recognizing these concerns in business, but then also in investment. So the whole view here is that these pension funds will manage liabilities and pay for people's pensions for many years to come, 50, 60 years into the future, if not longer. So that's part of the reason why California has been so focused on these longer term risks that they view as being very important. Also politically, there's a lot of political willpower at the ballot box supporting these sorts of initiatives. And if you look at other states, I'll use Texas as an example, where fossil fuels is a big industry for them. State pension funds, public pension funds, they're really pulling back and saying, we don't want these climate and sustainability supporting industries to become dominant, because that could endanger the oil and gas industry, which is clearly important for them as well. So just even within that, there's this interplay between the political, the workers who are in these affected industries, but then also the pension funds that are managing the money that are going to be looking after them, that are often at the state level. So huge challenges there between huge differences between those different types of states.
It seems to me, if you look at three major groups that are sustainability focused, there are scientists who provide a context for whether or not this is something to worry about. Then there are firms such as insurance companies who are likely to be hit economically and therefore be affected in terms of stock price, shareholder value, etc., because of events that might happen when sustainability is not cared for sufficiently. And then there are the countries themselves who need to think about the welfare of the nation, the people, their economy, competitiveness, global competitiveness. And nation states probably have to work sometimes in concert with other nations in order to take collective action. My question is, do these three groups see eye to eye? Do they look at the data differently and interpret the same data in different manners and therefore come to conclusions that are quite different about whether or not they should take action and what kinds of action to take?
I'd say that's one of the biggest challenges we have right now, is that you have different groups with different priorities over different timeframes as well. So I think with a lot of scientists, in fact, nearly all of the scientific community, from what I understand, is very much concerned about the slow pace of adaptation and slow recognition of climate risk, and making sure that businesses, governments, consumers are changing their behaviours effectively. From the business side, I'd say that multinationals are very aware of the different risks because they are exposed to them on a day-to-day basis. But again, it comes down to the time frame they're looking at, because some of these changes that they need to put in place to the business can incur a short-term cost. But over the long term, they are designed to pay off. So I think if you think of, say, the airline industry, right? So the airline industry knows that it needs to transition away from fossil fuels as much as possible, or to use more effective, more efficient fleet. Now, buying a new plane, which is more efficient, costs more in the short term, but over the long term, especially if fossil fuel prices remain high, then it pays off. So there is that long-term versus short-term trade-off there. In terms of governments and the nation states, again, there's a real temporal dimension to this as well. So in countries where you have a relatively short electoral cycle, where there's big shifts, and we've seen some of those big shifts in recent times in different where people with different viewpoints have control or more power, then yes, there does tend to be an emphasis, unfortunately, on the shorter term. You see this in the way that infrastructure is being built or not being built in many cases. You're seeing this in terms of the types of policies and subsidies that are being allowed for different types of industries. So a lot of this does come down to that long-term versus short-term. I think the biggest challenge we have, though, is that the risks that 10 years ago we were saying are long-term are emerging and are hitting us right now. They are short-term now. The hurricanes, the temperature rises, the floods, the fires, they're here right now, and they're affecting us. So I think that at some point, viewing climate as a long-term issue will need to change to become, well, climate risk is in the here and now.
Now, there seems to be a conflict between sustainability and growth, a perception that there's a trade-off and that it's a zero-sum game. So are these two goals, improving sustainability and higher, faster growth, are they inherently incompatible?
I think a lot of people ask that and have that concern. And again, I'll come back to the point about this is a time frame issue.
Mm.
So in the immediate point in time, yes, it can be a zero-sum game. If I've got, if I'm a company and I have to make a capital investment, right, and I can choose to do something which is cleaner but will have a longer-term payoff, or something which is dirtier but have a shorter-term payoff, then sure, I can understand why some companies, especially those who are more short-term oriented, face pressures from financial markets, face pressures to make sure they meet analyst forecasts. They might take the easier path. But if we're thinking about the long-term guidance and stewardship of these companies and of our economies and our societies, well, that is what a lot of these governments, what a lot of companies will have to manage to at some point. And again, yeah, if the long term becomes the short term, which is increasingly the case, then it's not going to become a trade-off anymore. I'd say if you think of, say, when you're building a new property right now, a new building, say you've just had a fire burn down your factory in California. When you come to rebuild that, actually deciding whether I'm going to make this more fire resistant doesn't become a long-term issue anymore. It becomes a survival issue. It becomes a necessity. So I think more and more companies will be shifting towards that out of necessity. Now, if you get ahead of that curve, you can be proactive. You can view it as an opportunity potentially. You can potentially reduce the longer-term costs you're going to face. If you become reactive and it's all about sticking plasters and trying to do quick fixes, I think it's going to be to your long-term detriment.
Mm-hmm. I'm reminded of the Getty Museum recently, that they have been investing for many, many years in creating fire breaks and investing in sprinkler systems and early alarm systems and more fireproof roofs, etc., because they have a very valuable art collection. And so they were spared any real consequences from the horrific fires that swept through LA, and were really within half a mile of the Getty Museum. So it seems to me that there are many different approaches from what you say. There is, for example, the technology issue, right? You can use technology, carbon capture, carbon reduction techniques. You can, of course, move to more sustainable fuels. That would be another solution, reduction in fossil fuel usage. There are also fiscal solutions from the market-based approach, which is say, maybe putting in a carbon tax and offering carbon reduction tax incentives, such as, for example, the well-known incentives for buying electric cars in the U.S. And then finally, of course, regulation, which seems to me right now a bit of a dead end, at least in the U.S. So would you want to comment on these different approaches, and do they have to be integrated, or can one or two of them continue to function regardless of what happens in the broader environment?
Yeah, I'd say that it obviously helps if those different forces are integrated and are aligned, but clearly we're in an environment where that's not the case. So I'd say that where there are some positive pressures is from the market side still. So not necessarily just from consumers. Consumers, yes, they are caring about climate and sustainability related concerns, but that's generally at the margins. I'd say the biggest movers that I'm seeing are actually the companies who are doing the manufacturing, who are doing the heavy lifting operational type work, because they're recognizing that fossil fuels are expensive, are volatile compared to when it comes to other renewable sources of energy. That energy reduction actually is good for the bottom line. And so you might not see as many companies talking about that, but actually they are still putting that in place because they just recognize it makes good business sense. So definitely from that sort of energy use and material use perspective. In terms of the other types of levers that are there, the technology one, for example, one of the challenges on the technology side is that a lot of it is still unproven. A lot of it is still under development. And yeah, it'll be great once we get really feasible carbon capture. There is some promise there, but it's still too far into the future unfortunately. It'll be great once we can move into hydrogen fuels and the like. But again, the technology isn't there yet. And given the urgency, given the speed with which temperatures are rising, it does mean that the technology is probably going to be too slow to have a meaningful dent and to put a meaningful cap on these temperature rises.
Now, you worked with this sustainability issue as an investment banker, and you've also been an academic studying it from a slightly more distance perspective. So my question is, as we conclude here, what are the future prospects for positive progress in this area? Are you an optimist or a pessimist? And how might those two outlooks look?
As someone who deals with this on a day-to-day basis, I'm naturally leaning towards pessimism, unfortunately. When I see how much needs to be done and how much isn't being done, then that makes me very concerned. When I see that year after year, summer after summer, it gets hotter and hotter. When I see that the year after year, the weather extremes are really there, it does make me very, very concerned. I try to sprinkle in moments of optimism, of course, and there are those for sure. I'd say that the one that I am optimistic about is that there's hopefully enough inertia within business already recognizing the benefits and the opportunities for reducing costs, for improving efficiency, for reducing risk, that all of those are very sensible things to do. And so that there's, in my view, I think there's enough momentum that most companies will follow through with the path they've taken. It's just at what speed they're going to take. Are they going to slow down a bit more now, given that the environment's pushing against that, or are they going to stay the course and take really ambitious climate action? That we'll have to see how that one plays out. The other part where I have some optimism is with regulation where there is extrajudicial reach. So once the European rules properly come in, once you have the California rules coming in, it affects so many companies in lots of different jurisdictions. If they want to do business in Europe, if they want to do business in California, they're going to have to adhere to these rules. But at the same time, how much of those rules will get watered down over time before they actually get implemented? So I am unfortunately pessimistic because we've seen so much of this being rolled back over time. But my hope is that there's enough momentum there, that there's enough recognition that things are getting harder. So let's pull up our bootstraps and actually start doing that really hard work.
Well, it's a somber note, but at the same time, I think it's a very important question. As you say, even if it's not thought about over the next 3 to 6 months, in the medium to long term, it's going to continue to be of pressing importance. So thank you, Kevin. That was a very enlightening conversation on a subject that is going to be of continuing importance, I think, to society as well as to organizations and to individuals, to consumers. To our listeners, thank you for joining us today and listening to this episode of International Business Today, talking about sustainability. If you've enjoyed this episode, do subscribe and come back and revisit our older episodes and continue to follow us as we launch new episodes roughly every 2 or 3 weeks going forward. And we'd, of course, love to hear from you, your thoughts and comments and opinions, and suggestions for future topics for this podcast. Until next time, this is Professor Ravi Sarathi, my guest Kevin Chuah, and we both thank you for your time and attention. Have a great day. We'd love to hear from you and see you again on our next podcast.